All right, it says we are now live, so we're a few seconds, I guess. Right, hey, right now on the slide, y'all don't see happy screen sharing or anything, do you? You just see the slide?
We just see the slides. You're all good.
All right, very good.
Now I see your kids, but
That was my home screen. Got to be careful with that, don't I?
Yeah. I mean, you don't want to put a picture of your girlfriend up there.
Right. All right. Well, it looks like it's 1 o'clock, and so welcome everyone that is attending this session for the Society of Settlement Planners. This is qualified settlement funds and practical use cases. And as you can imagine, with a matter this complex, there's a lot of interest in knowing more about qualified settlement funds and the various facets of utilizing qualified settlement funds. Today we have Glen Armand with Eastern Point Trust Company. Say hello, Glen.
Hey, guys.
And we also have Les Marsh with RMAC Inc. Say hi.
Good afternoon.
So if any of you have attended any of the other panels thus far, I can tell you that this group of panelists are the handsomest you've seen so far. So anyway, for the sake of time, Les, real quick, if you don't mind, would you mind sharing with the group kind of what your primary practice is, and that way they'll know the difference between Les and between you and Glen?
Our primary practice has to do with helping plaintiff attorneys and plaintiffs in the post-settlement issues of their cases. Sometimes we're brought in to help during the settlement conference or prior to the settlement conference, but mainly we're just there to make things a little easier during the post-settlement process.
Gotcha. And Glen, how about yourself and your firm?
With Eastern Point Trust, we provide a variety of trust solutions to settlement planners, including qualified settlement funds, as well as special needs and settlement protection trusts and some other specialty trust solutions.
Very good. Very good. Well, and for the group that doesn't know, I'm Andy Cook, and I'm with Evolve Bank and Trust, a board member of the Society of Settlement Planners. I'm not a settlement planner, but certainly have been in this realm and worked around this space for a number of years and really enjoy it and certainly have developed a broad knowledge in this space. So for the sake of time, I'm going to move over to the slide presentation, and we'll start out with what is a qualified settlement fund? Just in basic terms. Glen, you want to take a shot at the qualified settlement fund? What is a qualified settlement fund?
Sure. I think the easiest way to think about a qualified settlement fund, and we often get that question, even from attorneys who've been practicing for quite some time. So I would, share that don't assume that the lawyer that you're working with knows what a QSF is or has ever used one. And I think the easiest way to explain it is a qualified settlement fund is like a 401k. It's a tax creature. It's part of the tax code. It comes from 468B instead of 401k. But it provides certain tax deferrals opportunities so that the defendant can put the money into the QSF, take their tax deduction, be done with the case, but you have no constructive receipt, you have no economic benefit, there's no triggering of the cash receipts doctrine. So it gives the plaintiff and their advisors time to work out what's the best options that are available. It's important that you have an independent trustee safeguarding the funds and making sure that the fund has met the requirements of 468B. But that's what a QSF is in a nutshell.
All right, very good. Next, it's how are qualified settlement funds established? I know that there's some banter back and forth as to which jurisdiction, what type of court, this, that, and the other. Glen, I'll let you touch on that because you're intimately involved, and then Les, you may want to comment from a settlement planning perspective and some of the relationships you have. I know you've done some work with Glen, but maybe there's some other experience as as to how these may have been established. Glenn, go first.
Sure. The great thing about 468B is that it says very plainly, right in the regulation, 1.468B-1, exactly what constitutes a qualified settlement fund. There are three basic requirements. One of those is that the QSF has to, it has to, you can't create a QSF for unrelated matters. So it has to be one or more related matters. And unless I know you've had some experience with that, and I'd ask you to comment about that just in a minute, about where you see QSFs that have unrelated matters that are, in the same QSF and some of the problems that that's caused. But it defines very clearly in the regulation that a governmental authority has to approve the QSF. And it defines what those governmental authorities are. So it can be the U.S. government, it can be a state, it can be an agency of a state, it can be a political subdivision of a state. And actually, if you look at the regulation itself, you actually look at the text, it says in parentheses, or a court. So there is no requirement that a QSF be approved by a court. It does have to be approved by a governmental agency. Certainly a court can approve a QSF. And we have situations where we have QSFs that are created by governmental agencies, but then we have the settlement court that in effect reaffirms or accepts the QSF as created. So sometimes you have both. You have both a governmental agency that approves the original creation of the QSF, but then you have a court that is a settlement court who retains their authority over the settlement. Creating a QSF does not erode the settlement court's power or jurisdiction over the original terms of the settlement. But Les, you might, if I could ask you to weigh in. I know you've been working with some problems associated with so-called master steps, and share with us some of your experience.
Yeah, I'd be happy to. We have we deal really with defendants now and with plaintiffs more than we ever had, but most of our practice was plaintiffs, and we just explain that by novation, we're just displacing the defendant. So there's lots of different feelings out there, especially if it's the first time that the plaintiff attorney has used a QSF. And sometimes that they get territorial and they want the QSF to be in the same district as the case is, and they want to present it to the defense and saying this is where we're at, and handling the arguments. But those were quite cumbersome, and when they do that now, what you have groups like Glen, they're very easy to put in place, and they're timely and they're cost efficient. So when we run into a trial lawyer or a law firm that we've done work for their second or third go around of senior partners, we're still working, but the lawyers managed to be smart enough to retire, and they come up with a master QSF or some type of offshoot with that, maybe a pooled trust. It's the same thing. It has to be a related claim, but we just have come out to the point where we just say we have big mistake, little mistake. If you can't get that qualified settlement fund approved, it's not costing you $25,000 to $50,000 like the QSFs used to cost, and it's just cleaner to do it the right way. And that's the one thing I like about trial lawyers. You can have your argument, but you better prove that that you're accurate, and you have you have somebody with the tax LIM behind them, establishing what you're doing is appropriate. So I'm not sure, Glenn, if that answered your question, but it's never been easier to do a qualified settlement fund, and we still have attorneys that have complex cases and they want to have it in their area for their bank, and they want to present it to that judge. But by and large now, because they have some confidence in what we're doing, they let us do it more efficiently, and doesn't take long anymore. So hope that helps.
No, very good, very good. The next question we have is, ideally, who should administer the qualified settlement fund? I know in the years, it's probably been 15, 16 years since we have ventured into this space, and I receive all kinds of phone calls from folks that think we do everything. Really, in reality, all we do at Evolve is custody the assets for various administrators, kind of Switzerland of sorts. But I've heard everything from the settlement planner wanting to administer the QSF to various parties, standalone attorneys, corporate trustees, this, that, and the other. So again, I'll start with you, Glenn. In your opinion, who should administer the qualified settlement fund, and what type of perhaps E&O coverage? Should it be an entity? Looking at all the things that may or may not go wrong with the QSF, that tying it up at the end with the taxes and tax filings and whatnot. I didn't think that a lot of settlement planners had the E&O coverage in case something like that went south, or you sent out money you weren't supposed to send out, you can't get it back. So can you touch on that briefly? And then Les, if you have a comment, please do so.
Well, I think you bring up a good point, Andy, and that's one of many elements. I mean, does the person who's acting to administer the QSF, do they have adequate fidelity bond coverage? I mean, what happens if money just mysteriously disappears? I mean, we all know in our industry here within the last year, we had an instance where, there was a gentleman who misappropriated quite a bit of money, and the shortfall that creates the impact on the claimants is maybe unrecoverable. Errors and omissions insurance is also important, but I think more important than all of those are kind of the at the end, worst case outcomes, and it's important to have that in case something does happen. But is having an entity, and I do think it should be an entity, because you should have segregation of duties. I know in our organization, we spend a lot of time in terms of, Andy, as I know you do as a custodian, is that, I mean, there's not just one person that can move money, right? There's a process. There's a series of checks and balances. There's financial controls that are in place. And so I think if you as a planner are looking to do business with someone as an administrator for qualified settlement funds, the questions are to ask, what are those financial controls that they have in place? What are the segregation of duties? How do they safeguard the funds? Are they a regulated entity? Is there anybody that's looking over their shoulder? I mean, some of the largest QSF administrators, they're no more than an LLC that somebody created, and they have no governmental oversight at all. Andy, I'm sure, like you get the good folks from, the regulators that come in and, they test accounts and they verify that your procedures and your controls are adequate. And if they aren't, they're bringing that to your attention and insisting that you correct it. If you have an unregulated entity and something goes bad, how are you going to defend yourself as a settlement planner in that you chose someone who was an unregulated entity versus a regulated entity? And so those are some of the things that I think, are worthwhile asking. Les, what's important to you and your clients?
Well, that's kind of relates to the last question that you had for me regarding maybe qualified settlement funds outside of it. But we don't use qualified settlement funds as a source of income at all. It's just a pass through. We're trying to do a service for the attorney. And to do it right anymore, we don't think a party to the settlement, whether it's the defendant or the plaintiff, should really be handling that qualified settlement fund. Now, we've seen both. We've seen all kinds. We've seen the banker, that's the plaintiff attorney's friends, be the head of the qualified settlement fund and all that stuff to save money on small cases. But we really think it needs to be a third party. We really think that it should be a corporate fiduciary. We had a case where the attorney said, well, why don't you handle all the funds and all that? I said, well, I wouldn't want to handle all your funds. I just am here to do the settlement planning. We have a corporate fiduciary that will do it. Big mistake, little mistake. So for $1,000 or $2,000, you can get it done right, or you can save that. And in my view, it's not worth the risk. So there's been quite an evolution, but the costs of the qualified settlement funds are good. And frankly, we probably use more qualified settlement funds now for small cases for people protecting their government benefits. And we never had an ability to do that before. For special needs trust, the banks and trust companies used to require a lot of money and still do. We can do that now. And that $70,000 might be more important to that person on Medicaid than $700,000 is to someone else who doesn't have that issue. So to answer the question, we like the corporate fiduciary. We think that's really the only way to go, especially at the costs that they're doing it for now.
Yeah, while we're in this area, I assume that most everyone that's in this space, and again, I'm kind of on the outside looking in when it comes to being a settlement planner, but there was some dialogue on one of the blogs online regarding operations or firms these days that are a settlement planning firm offering structured settlements, offering trust services, handling lien resolution, also administering qualified settlement funds, and whether there was any concern or impropriety that they were operating the qualified settlement fund and also selecting or to a sister organization, I guess, if you will, or a subsidiary for the trust business, for the structure, all within that same ecosystem. And I don't know how I feel either way. I don't know that that's important, but do you have a comment in regards to how appropriate that may or may not be when it's all within one ecosystem for a settlement planning firm, as best I can describe it?
Well,
Well,
there's
go ahead, Les.
go ahead, Glenn. Well, there's a lot of different ways of doing it, and I never feel like I have a lock on all the good ideas. But to be involved in if I think I understand you right, the qualified settlement fund, then hold the investments, and then maybe run the non-qualified assignment, and then maybe do that. I'm all for doing stuff that makes it easier, but personally, I wouldn't want our company to control all that stuff. I think you need a third party for it. And here again, if someone has the ability to prove that that's a viable deal, and if a trial lawyer who we had a trial lawyer that was skirmish on non-qualified assignments, and we put hundreds of millions of dollars on an environmental claim, and it was very tough for him because it was an offshore company, and that same guy came to us because somebody wanted to do everything. And sometimes we just get to the point where we get so hungry for this business that we don't stay in our lane. And somebody wants to do that. That's part of what's going on out there.
Well, I think I'm in it more from the standpoint of figuring out who's actually controlling what. In other words, early on, I did administer one or two qualified settlement funds early on, and I was constantly taking a barrage of instructions from the personal injury attorney. And at the time, you're like, who's directing traffic here? I'm trying to figure that out. So, if your own firm is handling the administration and serving as trustee or administrator of the qualified settlement fund, and your own firm or subsidiary is recommending a particular structure, annuity, or a special needs trust, I just didn't know if that's in the best interest of the client or not. Appears to be a wonderful business operation. I just didn't know what your thoughts were, Glenn.
Well, we've certainly seen some scenarios where we've had QSFs brought to us, and then there was the expectation that we were just going to rubber stamp decisions, and that the organization bringing that case to us could make demands that we would act in the best interest of the organization and not in the best interest of the claimants. And so, Andy, you're right. I mean, that tension can exist and does exist. And so, whether if you have an organization that has all of those elements and, they're all sharing the same bed, so to speak, maybe the fiduciary obligation to the claimants is not as vigorous. I don't know. I wouldn't want to suggest that it isn't, but it's an interesting question to ponder.
Yeah, something to ponder. Let's move on, because I know we're going to run through some time here. Who should serve as custodian of qualified settlement funds? And obviously this is different. I mean, Glen's organization serves as the administrator. We serve as a custodian, and there's a variety of folks in this space. This may be an easy one. Les, who do you prefer when you're dealing with your personal injury relationships? Who do you think they prefer to hold qualified settlement funds assets? Is it large banks, small banks, independent trust companies, broker dealers, or any of the sorts? I don't know.
Now, personally, we prefer a corporate fiduciary, and one that doesn't want to compete against the funds. In the old days, you would put these huge amounts in. Next thing you know, the trial lawyer was wondering why I couldn't get a better interest rates, or why my administrator couldn't get a better interest rate than the bank who wanted to have all this business, and kind of all gets convoluted. So it's just cleaner to have someone else other than yourself, and to have someone other than one person. Corporate fiduciary is what we feel most comfortable with.
And Glen?
Yeah, and Andy, we don't custody the funds ourselves because we're non-depository. So we always use a bank. But that's an array. I mean, we have banks that are in the, top 10 of banks, and, we have smaller regional banks, but, we slice up our deposits so no bank is holding more than $250,000 of any one claimant's money. So we can increase the amount of FDIC insurance that is available. But I think having a bank as a custodian makes the most sense. I have some real concerns about some of the QSFs that invest, for example, in treasury bonds, while they won't, theoretically, U.S. government bonds won't default. They are still subject to market risk. And so there's some liquidity issues, and there is the potential for principal loss. And so we're not a big fan of having QSFs held in treasury bonds because of those risks.
Yeah, and we'll get to that question here in a minute. With the laddering of treasuries, we've had an array of large investment firms that found out we were holding qualified settlement fund assets, called and discussed the investment strategy, willing to offer to ladder this and that. And I think at the end of the day, you can't build a large ladder without incurring additional expenses that otherwise you won't see if you're just putting it in bank deposit money markets and whatnot, like you're talking about. But of course, most of the investment language in these qualified settlement funds is very, very tight. So you don't have a ton of leeway, which leads us to what investment options are appropriate for qualified settlement funds. And I think, Glen, you've already alluded to that. I think most of what we've seen, even though it may mention agencies or treasuries in some of these investment policy statements or the sections on investments within the QSF, most of it is obviously stability of principal, minimize any risk of loss. And so it's really narrow. It's generally bank deposits, insured treasury money markets, or something. So unless y'all have anything to add, I'll give you a second. I'll move on to the next question.
No, I think you hit on it.
Okay. What fees and costs are associated with qualified settlement funds? And again, it really depends. I'm just going to throw my 2 cents out there, and I'm going to because I know Les has before he did business with you, he did business with others. You have very, very large institutions that may want to treat it like an analysis account if you're walking it into the bank. And of course, every bank on every corner would love to have $100, $200, $300 million qualified settlement fund. What they don't understand is that the attorney may call up 3 days and say, I need you to send 200 back out. And so they don't understand that if you're not doing this on a regular basis and you've got 50, 70, whatever number of these active at all times, where you have aggregate balances, that some of these can go very quickly. And as Glenn and I have discussed, some of this stuff may hang around 4, 5, 6 years if it's an asbestos type deal and it's replenishing. But anyway, from a fees and costs perspective, varies. Some have transactional fees. Some are able to generate revenue just off the spread. But of course, in today's environment, at 0 to 25 or 0 to 30, that's very difficult. So I think in our case, each deal is specific. It's deal specific. It's very difficult for us to have a stringent fee schedule. And the reason I say that is I may have a administrator that has a constant deal flow, and we're going to be much more friendly to the constant deal flow than we are the one settlement planner that calls up, says, hey, I got a $20 million QSF, and I've never even met the guy before or gal, and don't anticipate any future business. But that is more suitable for others. And Glenn, I think y'all do a very good job from a technology perspective making that possible. But that's just my perspective. Les, what have you seen both prior to meeting with Eastern Point and now that you're with Eastern Point? And you don't have to get into specifics on what the amount of fees are, but maybe the fee types and costs associated.
Well, yeah, the use of the QSFs that we started in the early 90s were very expensive, and they were really hands-on by the trustee administrator, and a lot of those were done in the jurisdiction of where the case was. So that has the extra expense of notifying, at least at the time, not being a lawyer, notifying the defendants of the use of the QSF and giving them a chance to respond. We facilitate then, like we facilitated now. It's just a pass through. It's not a profit deal for us. We're just trying to get in a position to help them with the post settlement. So yeah, they've gone down dramatically. And if they are like most of the QSFs we do now, they're done in a different court where it's easy for the trustee to do it. And fees, we're tens of the thousands of dollars. So now what we're seeing is much more efficient. And
yeah, I think
as far as the interest rates go, sometimes that would be what we would take was the interest rate in the QSF as our part of the fee. But just like the trust companies, there really isn't anything there now. And our opinion was we didn't really want the interest going anywhere else. If it went somewhere, it was to a charitable fund. At the end, it wouldn't be going back to the claimants. And there's mixed opinions on that.
So you may have initially, depending on who does what, but you may have drafting fees to draft the escrow or trust agreement. That used to be even 10 or 15 years ago, very cost prohibitive. Could be 10 to 15 grand per doc. Yeah. Easy. And I'm just spitballing. And then you may have transactional costs. I mean, obviously anybody holding the money, any bank needs, they're either going to make money on spread or they have to make it on transactional costs. Because nobody's going to take it and not make money because you have liability this, that, or the other. And those same regulators that come in, like Glenn said, to visit us, feds and state, would say, why in the world are you doing this and not making any money? So there are a variety of touch points. Glenn, did you want to touch on that?
Yeah, I mean, Andy, you hit the nail on the head. I mean, since the beginning of last year, the landscape in terms of what are the fees and costs have changed dramatically, primarily because of the interest rate environment. I mean, we're we have a group in our, on our team that reach out to hundreds of banks a month to poll them as to what, the interest rates are. And we routinely see interest rates sub 10 basis points. It's 0.1%. And so it's very, very difficult. And certainly our platform was built on the idea that we could use that, that float to help subsidize the cost and make it very cost effective. So it's been a real challenge for us to keep our costs down. I think we've done a good job doing that through innovation and continued development. For example, some automated ways to ask for distribution. So there's not as much hand holding associated there. But I spoke to a settlement planner the other day, to your point, and he was saying, look, I've been using a resource that they charge me $10,000 just to draft the document. And, so that's, our costs are substantially less than that. I mean, sub $500. And in terms of QSF administration, there was a very, very large, and this is, public information, there's a very large case with tens of thousands of claimants where the QSF administrator is charging me $700 a claimant. I mean, I'm flabbergasted as to how you need to charge $700 a claimant, but they, that's the structure. So it, suffice it to say that, there's a great deal of difference in fees and costs that are out there. And I think as a settlement planner, looking into that, maybe challenging what the fees and costs are that you're paying now if you're using QSFs, it would be a good thing to do.
Well, and I think too, it's not only challenge the fees, but also recognize that a wise man that used to run this trust department told me, everybody's got to eat. And so at the end of the day, I've talked to plenty of settlement planners that think they're going to drop $20 million, $50 million, $80 million in here and it be gone within a week and expect for somebody to be paid. And it's just not feasible. I mean, at the end of the day, you got to look at what's the duration of the fund. Some are quick, some are long. And again, everybody has to be able to eat, for lack of a better word. And there's really no free ride. But I can tell you, if you walk it into one of the larger institutions, because you see that they're going to pay you some number that's twice what they hear from you or me or anyone else, because you're shopping institutions, we're shopping institutions to be able to farm out hundreds of millions of dollars. And at the end of the day, those bank partners that you have, they don't want money coming and going. They want sticky assets. And so you try to keep balances with your best partners. And so,
you're absolutely right. I mean, we got a QSF on Friday. The money's supposed to come in today, $12 million. I got an email at 9 o'clock this morning saying, oh, by the way, 10 million is going to leave tomorrow, the next day.
Yeah.
So you're going to get the money today and 10 million goes out the next day. And that's not unusual.
Well, yeah. Go ahead. I'm sorry.
So there you have it.
I think where we really see it or have seen it in the past, quite frankly, it's large amounts in and attorney's fees going out immediately. I had one time that the funds had not even cleared to become good funds, and I was being hammered to get out some attorney fees. So that wasn't very nice. But anyhow, moving on to better things. How can settlement planners implement QSFs into the settlement process? And I know that at various SSP conferences, there's a heavy emphasis on the details of qualified settlement funds. And I think for those that are looking at this today that know me, I'm really more about how does everyone go out and make a living? How does everybody grow their practice? And I like to look at it from that perspective. And I've talked to a number of settlement planners, some of which have never done a qualified settlement fund. And I wonder if it's because of the type of law firms that they're engaging. I try to wonder why that is. And then you have others that are very active in the settlement fund space, non-mass tort and whatnot. And so, Glenn, I know that both you and Les are in a much better position than I am to talk about this, because you have various experiences with other settlement planners that have successfully either forced it into this situation, or have been able to educate the plaintiff attorney to get comfortable, because it's obviously becoming more commonplace. But Les, how would you suggest settlement planners implement these? Is it early in the conversation? Is it just saying, hey, this is the way it's going to be? What tips do you have there?
Well, of course, earlier is better, but frankly, most of our opportunities involve we'd like to do a special needs trust, and the money is in our IOTA account. So, which just means we didn't get to them in time to introduce the use of the qualified settlement fund. But a lot of attorneys have heard of them; they just haven't used them, and they have their own experience, whether it's they think it's a mass tort or they think it has to be a large case. So we try to just encourage them to go in and help them with settle a case. And that's the idea. We're just trying to help them settle the case. And then once they get comfortable using the qualified settlement fund, they start coming up with cases for you that it would be a good idea to have the use of the qualified settlement fund to decide whether we need to preserve Medicaid, whether there's a crawlback provision or another plaintiff out there or another defendant out there. So right. We're just doing it. No one really, I don't know how many attorneys anymore will do a QSF just so there's an opportunity to do a structure. We're just doing the qualified settlement fund to give the plaintiff some time after the settlement and protect their the constructive receipt issues.
Right. And Glenn, what's been your experience dealing with settlement plan and assisting them?
I think, let's hit on it at the beginning. Is the first thing is education, and the opportunity for the settlement planner to educate the attorney that QSF can be used in a lot of scenarios. I think part of that education is also to communicate to the attorneys how QSF can actually reduce their liability. There's a case that we had down in Louisiana that involved a bank, and we were consulting on it, and the law firm decided not to do a QSF. And there were a number of the plaintiffs that ended up having government benefits, and as a result, a number of those plaintiffs lost their government benefits because the money didn't go into the QSF. That particular state was very aggressive about money going into an IOTA account, which if it goes into the IOTA account, I think we've shared with the SSP before, Rob Wood's opinion that money becomes actually received. It's an available resource. And so your only option is to spend it down. And now that law firm is facing some, significant claims from the plaintiff. They've gone from being the litigator to the litigant because they've got folks coming back to them and saying, you messed me up here, guys. I lost my government benefits because you didn't handle this right. So I think education is a good thing. You're explaining to the attorneys how it's good for the clients. It reduces their liability. I mean, why would you want the money to go into your IOTA account where you have to manage it and monitor it and be accountable for it? If it goes into the QSF, the lawyer washes his hands and he's done with it. But also settlement planners can use the QSFs to, I think, help them better control the case. We've certainly seen that. Our biggest producer, the person who brings us the most number of QSFs, he just insists that a QSF is used. And as a result of that, his practice has grown tenfold. And so some planners may not be, comfortable with that. They may want to work with the defense side broker, but there are guys out there that have said, the defense guy never brings me anything, so why should I work with him? That's an individual choice. We're not advocating here that you should pick one or the other. We're just sharing with you the experiences that we've seen from settlement planners that take different approaches.
Yeah. So the observation is that those that are I guess more confident in what it brings to the table, eliminating the very mess that attorneys don't want to deal with, and the reason they hire folks to do lien resolution and everything else to get it off their desk. I guess what you're saying is, from what you and I have seen, is those folks that walk in and say, hey, this is what I believe in. This is how it can help you, help your clients, and it's the right thing to do. So, and that's not, again, that's not something we're saying to do. We're just saying it appears that those that are most successful really aren't afraid to step on out there.
Absolutely.
Hey, Andrew.
Yes, sir.
Andrew, do you see
sir.
the question there from Mr. Halterbeck?
I do not. I was trying to hold Q&A to the end.
Okay. All right. I just thought it would. Okay. Very good.
That's okay. That's all right. Let me.
I just thought it would tie into where you're at.
Q&A. Let's see here. Is there any guidance on using a QSF alone as a vehicle for multi-year income deferment for taxable settlement and or attorney fees? So the old question of, hey, if the attorney would like to leave the money in there. We
actually worked with Rob on that question as well. And there's nothing definitive in the code as to what the life cycle of a QSF can be. The QSF or Exxon Valdez is still open and operating. What's that, 40-something years? So the IRS has never given you any bright line test to apply. What we have developed as a policy with Rob's guidance is, as long as there's a secondary matter that is in conflict, the QSF can remain open. I mean, obviously, if you haven't been able to figure out who all the claimants are, if you haven't been able to figure out what the allocation is, or there is some other secondary matter. For example, we have a case with Les where we have a QSF, but the money in the QSF, I think it's family members are fighting over, and there's secondary litigation about who's supposed to get what portion of the QSF. So we can leave that QSF open. In the absence of that, we put in a 1-year rule. So if there's no secondary matter, if there's no unresolved issues, from that date forward, we're asking you to get that QSF cleaned up and terminated within a year. So to that end, we don't believe you can use this as a multi-year income deferral just for attorney's fees. Now, could you use it where, hey, it's October, November of this year, and we're going to put money in, and the lawyer is planning on taking it out in the middle of next year? Sure, that's within that 12-month period. It's a reasonable period of time for the attorney to figure out what they're going to do with the money. But just leaving the money in the QSF purely for the purpose of a multi-year deferral, we will not take cases that way, and we believe that's very dangerous. And I don't want to speak for Rob, but I know in our conversations with him, he has shared that same thought, as other tax attorneys that we have shared the same concern, that that's an inappropriate use of a QSF. So there you have it.
Yeah. Hardly, again, as custodian, we don't make those decisions. However, I have been involved and I have seen money hang around for X period of time to get into another tax year. I have never seen one that was devised solely for attorney fees only. But so I agree with all that, and I hope that helps answer that question. Moving on, what should planners know about 1099 reporting of settlements? And I may have gotten this wrong, but somebody mentioned banks versus the commissioner, and there's a tie-in there. Glen?
Yeah, if it's a taxable settlement, the 1099 is required to issue the appropriate reporting. And so you can't, and this happens to us, Andy, we get phone calls from planners who say, well, can't you just turn a blind eye, just not issue a 1099? No, it doesn't work that way. The penalties from the IRS are very severe if we're not issuing a 1099 properly. Mm-hmm. So if it's a taxable settlement, or there's a taxable portion of the settlement, and then the 1099 has to be done. And where that's particularly problematic is when it is a taxable settlement and the arrangement has been a contingency fee arrangement. The lawyer is working as an agent for the plaintiff, and therefore the plaintiff has to pay taxes on the entire gross settlement. So if the settlement was $1 million, the plaintiff is going to get a 1099 for $1 million. Again, we're assuming that this is a taxable settlement. This is not a personal injury case. But let's say the lawyer got 400,000 of that $1 million. The lawyer is going to pay taxes on his or her 400,000, and the plaintiff is going to pay taxes on the full $1 million, because there is no miscellaneous deductions anymore on your 1040. So you cannot take the tax deduction for the $400,000 attorney fees. And so I think Jeremy may have talked in his presentation, or he may be planning on talking in a subsequent presentation about how you can assign that claim prior to the settlement being finalized and avoid that taxation on dollars that the plaintiff never receives. But that's certainly, a very key issue that planners should be aware of when they're dealing with a case. We have a case that is associated with the Roundup settlement, and there's a huge punitive damage element to the case. The majority of the settlement is punitive damage. Well, that's taxable. And the plaintiff is very unhappy about how much taxes he's going to have to pay on the money that went to the attorney that he never saw. And so there are some solutions in the process. And Jeremy can fill you guys in on that. We believe this focused on QSFs here today.
So you're suggesting that you assign something to the QSF? Maybe I missed that.
No, there's a way to assign the claim to another type of trust. You don't assign it to the QSF itself. A QSF may be involved, but the point is that the QSF has got that reporting requirement and is going to report the full $1 million if done properly. Is going to report the full $1 million to the plaintiff. They're not going to report the net 600,000 less attorney's fees. And so it's an issue that settlement planners certainly should be aware of when they're dealing with taxable cases.
Gotcha. And this, Les, you may want to touch on this. I think you did earlier. Are qualified settlement funds useful for small cases?
Oh, absolutely. And they're a good way to introduce the use of the qualified settlement fund to a trial lawyer that's heard of them or hasn't heard of them and has never used one before. Try to make it as painless as possible for them.
And Glenn, I think that's because of his experience is primarily because of your firm's expertise and the ability to handle smaller smaller cases based on the technology you've built and this, that, or the other. Do you want to touch on that for us?
Yeah, I mean, certainly it is useful for small cases. I mean, we have some law firms that, as a rule of thumb, any settlement that's $25,000 or larger, they put into a QSF. And it goes back to that point that I raised earlier. They don't want the money in their IOTA account. They don't want the risk. They don't want the administrative hassle. By transferring the money into the QSF, it becomes much easier for them, much less risk.
Gotcha. Oh, sorry about that. Y'all still see me?
Gotcha.
Yeah, I'm trying to get back to the slide presentation. My mouse. Oh, here we go. My mouse. There we go. Might need a new battery. Can y'all see that?
I don't see the presentation screen, Andy, but it looks like we got about just 12 minutes left if we want to go over the questions or something, or maybe we can just touch on the other points verbally.
No, I got it. I just have to go broadcast again, I guess. Your screen. Whoa. How about now?
Yep.
Are UCC and bankruptcy liens involved with QSFs? I've seen something and didn't know what the nexus is there.
This is an issue that I'll admit is a little bit of a pet peeve of mine. So we see there are a lot of great vendors out there that do lien resolution for medical related liens, etc. But we often see situations where the lawyer and the settlement planner has never thought, because there are no medical liens, so they don't think about doing any lien identification. And that's what we're really talking about, is lien identification. When you're doing a payout of a QSF, there are federal and state laws that require the QSF to verify that there aren't any uniform commercial code, and those are state-based liens, right? That there are no UCC liens that are outstanding, and that there are no bankruptcy liens outstanding. And we see with great regularity that when we get in a request for a distribution, that the law firm and the settlement planner have done no checking to verify whether there's any UCC liens or bankruptcy liens. And as a result, then the QSF distribution gets hung up, or we have to reserve a portion of it adequate to be able to address the lien. Or we transfer the money, that portion of the money to the lawyer into their IOLTA account, which can result in other bad outcomes, and transfer the responsibility to them to resolve the UCC or the bankruptcy lien. So I guess what I would say is a cautionary tale. As soon as you're involved as a financial planner, as a settlement planner in the settlement process, do a UCC and bankruptcy lien search. You can do them online, free, and it's going to ensure that you're not exposing yourself to some kind of liability claim in the future, and it's just going to make the whole process a lot easier.
Well, in the case where you have multiple claimants, Glenn, even though it may be free to go look, but say it's hundreds of claimants, who bears the cost if they're, in today's world where everything is thinned out? Well, that doesn't even matter. Who is there a cost? So I guess time and effort, maybe, I guess is all. And if you have,
we have some automated tools, and our cost is fairly de minimis. I think it's in like the $5 range per claimant. It's not material, right? But the thing about UCC and bankruptcy is you might have checked 6 months ago. The lawyer might have checked when he took the case in, but that doesn't mean that there isn't a lien today. And so you need to check as of the date of the distribution. Now, that doesn't mean I would recommend you wait until the date of the distribution to do it. I would be checking all along. But we had a case where we had a claimant that had unbeknownst to the lawyer and the settlement planner, the claimant had sold 100% of their settlement to a third party in exchange for a discounted lump sum. And the third party had a UCC lien against 100% of the settlement. So if we had paid that out, that third party could have then come back against us and the lawyer and the settlement planner and said, wait a minute, you guys didn't perfect my lien. You didn't preserve my lien. And you had fair notice. It was, I filed it with the Secretary of State. So it's a problem we see on an ongoing basis. And, I think it's just something that folks should keep in the back of their mind.
All right, we've got about 7 minutes left. Since we mentioned the IOLTA, what's the difference? Well, we know some obvious differences between the QSF and the IOLTA, but I'm assuming in relation to handling settlement dollars. Glenn, touch on that, and then Les, I'm going to let you chime in if you want to or add to that.
I think the key difference is if the money's in the QSF, it's not constructively received, there's no economic benefit, and there's no cash receipt doctrine that applies. And so it's in tax limbo. As soon as the money goes into the IOLTA, it's actually received. It is taxable at that moment, and for government benefit purposes, it is an available asset. So those are the key issues, I think, if you're approaching this from a settlement planning perspective. And so the QSF gives you, avoids those issues and gives you time to plan.
Les, anything to add to that?
No, I would, not on the technical aspect, but a lot of times that's a good opportunity for us to go in, and maybe you can't do much with that one, but you've got them educated, and that gives you an opportunity. So that's
Gotcha.
not uncommon.
What are contingent qualified settlement funds, Glenn?
Well, this is something that Eastern Point created, but it actually stems from a rev ruling that the IRS issued. We will allow you to create a QSF and defer all the fees until the case is actually settled. And if the case is not successful, we'll waive the fees. And what that does is it allows you to name in the actual litigation the QSF as a party to the suit. And we've seen that as a very, very effective strategy to compel the defendants to make the payment into the QSF. We have settlement planners that do this on every case. It costs them nothing to set up the QSF. Again, we defer the liability for the payments until the end. And if the case is successful, then great, you pay us. If it's not successful, there's no payment that's due. But it puts you it establishes a QSF as a party to the matter and effectively erodes the ability of the defense to insist that there's a defense side structure.
Les, do you have any experience with that, or have anything to add?
No, contingent QSFs, we've participated in them. We didn't know they were an extra name, but that's not a typical use. And some attorneys really like it, and some attorneys like just having it into the settlement document, and that's good enough.
Yeah, I believe. Gotta go back. I believe that we're at the end, so it doesn't really matter. But the last question was, what level of control does a qualified settlement fund provide? And I think, Glenn, you touched on that earlier in the sense of a number of ways it provides some control. But do you want to close this out with whatever those hot buttons are, or the words that are most meaningful as to how it provides you with some control in the case?
Yeah, I think it goes back to, the proof is in the pudding, right? Is that the guys that we see are the most successful, and I mean the most successful by a significant degree, are the guys that are using QSFs aggressively and are using the QSF to garner a degree of control they would not otherwise have. And so, as a settlement planner, if you're not using QSFs, it may be a tool you want to look at, and it could bring you some benefits in terms of your ability to ensure a better outcome for your client, and in a lot of cases, ensure a better outcome for yourself.
Gotcha. In closing, Les, do you have anything to add to that?
There's a lot of people out there that would like to be a QSF administrator and involved with them. And a lot of times they just kind of create their own rules and stuff. I just have a more comfort level with somebody who does them day in and day out. So I'm not a paid advertiser for Glen, but somebody that does that quite often, or is a custodian that does it quite often, is a lot better to deal with than somebody who yesterday didn't know what a QSF is, and today now they're the administrator.
Yeah, that used to be me, by the way, 15 years ago or so. I couldn't spell qualified settlement fund, so I don't mind telling you.
I didn't.
If for anybody,
you repented from that sin.
Do what?
You repented from that sin.
All right. Well, look, we are 2 minutes from adjourning, so we might as well adjourn now. I want to thank Les, and I want to thank Glenn for taking their time. We hope that this was helpful in some regard. It's like always, take kind of what means something to you and leave the rest. Tried to keep it at a level that's not so technical that you get lost in the weeds, because you get lost in the weeds, you're not going to close any deals. It just doesn't. You're going to run the attorney off and scare everybody off. So at some point, hopefully you understand what these are about, how they might help your practice, and then bring in competent professionals, whoever they may be, the administrator, Glen's firm, other firms, and hopefully it'll help you grow your business. So with that being said, we're adjourned. Thanks, Les. Thanks, Glenn.
Thanks,
See
guys, for
everybody.
the opportunity.